Investing in Bitcoin has evolved significantly over the recent years, offering various avenues for individuals and institutions to gain exposure. Each method comes with its own sets of advantages and disadvantages. An investor could participate in transaction validation within the Bitcoin network and acquire coins by mining them. They can invest in publicly traded companies with Bitcoin exposure or purchase Bitcoin futures contracts. For today's conversation, let's focus on the two most common ways you can get exposure to Bitcoin. The first way is via direct purchase. You buy Bitcoin directly from a cryptocurrency exchange and typically store it in a digital wallet provided by the exchange or a personal digital wallet. The pros are that an investor could have complete ownership, direct oversight, 24/7 trading capability, and the potential for maximum financial appreciation without ongoing management fees. The cons are the necessity of technical proficiency, susceptibility to security vulnerabilities such as wallet management, managing private keys, and protecting against hacks, scams, and loss. Storing on exchanges also carries counterparty risk. Lastly, these exchanges typically charge fees for buying, selling, and sometimes withdrawing Bitcoin. The second way is through exchange-traded products such as ETFs, ETNs, and ETCs. The most common vehicle is the Bitcoin ETFs. So let's take a closer look at how that works. Spot Bitcoin ETFs hold actual Bitcoin as the underlying asset. When you buy shares of a spot Bitcoin ETF, you are buying into a fund that owns Bitcoin. Futures-based Bitcoin ETFs invest in Bitcoin futures contracts rather than holding Bitcoin directly. Their performance aims to track Bitcoin price through these derivatives. The advantage of these products is the simplicity and the accessibility, since they are traded through traditional brokerage accounts like stocks, making them easy to buy and sell for those familiar with the traditional investing. ETFs are also regulated financial products, offering a degree of investor protection and oversight not always present on crypto exchanges. Lastly, you can avoid the self-custody hassle. The ETF manager holds the complexities of buying and securely storing Bitcoin, eliminating the need for investors to manage private keys or wallets. As far as disadvantages of the Bitcoin ETF, there is no direct Bitcoin ownership. You own shares in the fund, not Bitcoin itself. ETFs also charge an annual management fee, which can reduce returns over the time compared to direct ownership. Lastly, an investor should be aware of possible tracking errors as well as the fact that ETFs don't trade 24/7.